The CRA has significantly expanded its audit and enforcement technology, and they're using it to target 5 specific areas where they believe Canadians are underreporting or making costly mistakes. Some of these might surprise you. We're not just talking about the obvious tax evasion situations. We're talking about everyday situations that many Canadians think are perfectly fine or they don't know about, but that could trigger an audit and significant penalties. By the end of the video, you'll understand what the CRA is prioritizing this year, and more importantly, whether or not you're at risk and what you need to do about it. Hi, I'm Stefano Francesca, Certified Financial Planner Professional and Senior Wealth Advisor at Next Step Wealth Management with IPC Securities Corporation. If you find this helpful, don't forget to like and subscribe. It really helps more Canadians see this. The CRA has expanded both the scale and sophistication of its enforcement efforts. They're using advanced data analytics, artificial intelligence, and international information sharing agreements to identify non-compliance. This year, they're zeroing in on 5 specific areas particularly relevant if you're nearing or in retirement. Audit Target 1, real estate transactions and the principal residence exemption. The CRA is using land registry data, MLS information, and AI tools to identify property transactions that might involve unreported income or improper use of exemptions. First is property flipping. If you sell a residential property within 365 days of buying it, or the right to acquire one, the profit is generally treated as business income, 100% taxable, unless you meet specific exemptions such as death, divorce, disability, job relocation, or insolvency. It's not a capital gain, and principal residence exemptions don't apply. Even if you hold longer than a year, the CRA can still argue it's business income if facts suggest that you bought with intention to resell for a profit. Second is misuse of the principal residence exemption. Common problems? Claiming it on multiple properties in the same year, claiming it on properties primarily used for rental, or not reporting the sale at all. Since 2017, you must report principal residence sales on Schedule 3, even if it's fully exempt. Third is unreported rental income. All rental income must be reported, traditional rentals and short-term rentals through Airbnb or VRBO. The CRA receives information from these platforms and cross-references against your returns. What you need to do, report every property sale, even if it's fully exempt. File Schedule 3 and designate the property correctly. If it's considered flipped property, then you'll have to file Form 2125, Statement of Business or Professional Activities. If it's a principal residence, be sure to keep documentation proving it was, such as utility bills, property tax bills, insurance, and driver's licenses. If selling within a year, document the circumstances. If you have rental properties, report all income and be conservative with expense claims. If you sold properties incorrectly in the past, consider the Voluntary Disclosures Program. Audit Target 2, aggressive tax planning and complex structures. The CRA has dedicated their most experienced auditors to unpacking sophisticated tax arrangements through the High Complexity Audit Tax Services Office. They're scrutinizing income splitting arrangements, family trusts used to shift income without proper economic substance, corporate structures set up to defer personal income tax, and offshore arrangements as well. Here's what's important if you're nearing retirement. Many Canadians have holding companies, family trusts, or other structures for legitimate reasons. Estate planning, creditor protection, business succession, these aren't inherently problematic. But the CRA is looking very closely at how these structures are actually being used. If a family trust is distributing income to children who aren't performing services or contributing capital, and their primary purpose is tax reduction, that's going to get scrutiny. The CRA wants to see economic substance, real activity, real contributions, real business reasons behind it, not just tax savings. The CRA now receives automatic information from over 90 countries about offshore accounts through the Common Reporting Standard. They're using AI to identify patterns suggesting aggressive tax planning. My advice, if you have a trust, holding company, or other corporate structures, review it with a qualified tax professional right away. Make sure there's clear documentation of the business or estate planning purpose. Be very careful about tax strategies that seem too good to be true. The general anti-avoidance rule allows the CRA to deny tax benefits from arrangements that lack any economic substance. This does not mean, of course, that legitimate tax and estate planning is discouraged, but it does mean structures must reflect real economic activity, not just tax outcomes. Audit Target 3, Foreign Property Reporting, Form T1135. If you're a Canadian tax resident owning specified foreign property with a cost more than $100,000 at any point in time during the year, you must file Form T1135. What counts? This is where many get caught offside. Foreign real estate you rent out or hold for investment, shares of foreign corporations, even in your Canadian brokerage accounts, funds in foreign bank accounts, and interests in foreign trusts. What's exempt? Well, property inside your RSP, your RIF, your TFSA, and personal use vacation homes. The threshold is based on cost, what you originally paid, not the current market value. It applies at any point in time during the year. If your holdings exceeded $100,000 in June, but dropped below by December, you still have to file that form. Recent court cases make this clear. In Horner versus the King in 2025, the tax court ruled that taxpayers can't escape penalties by saying they relied on their accountant. You must verify these forms are filed. Reasonable diligence demands more than passive reliance, was the court's findings. Penalties are significant for non-reporting, and if the CRA determines you knowingly failed to file, penalties escalate even further and compound. They can also extend the 3-year reassessment period, leaving your return open for scrutiny much longer than anyone would ever want. Keep detailed records of all foreign holdings. The CRA receives automatic information about foreign accounts worldwide and cross-references it. If you've missed filing previously, use the voluntary disclosure program. Audit target number 4, TFSA misuse and day trading. The CRA is actively auditing TFSAs where they believe the account is being used more like a business than a personal investment account. The biggest red flag is business-like trading activity. If you're frequently buying and selling, like day trading, using leverage, trading options, and profiting from short-term movements, the CRA may determine you're carrying on a business inside your TFSA. If so, the CRA may treat the gains from that activity as fully taxable income, even though they occurred inside your TFSA. The second issue is overcontributions. For this year, the annual limit is $7,000. The cumulative TFSA contribution depends on the year you became eligible and the annual limits in effect. The most common mistake? Withdrawing money and putting it back in the same year. When you withdraw, that contribution room doesn't return until January 1st of the following year. If you withdrew $5,000 in March of last year and are already maxed out, you couldn't recontribute back until this January. If you withdraw now and want to put it back, you'll need to wait until next January for that room to return. Another big issue here is your My CRA account. Financial institutions are required to report your account contributions and withdrawals on an annual basis, just once a year. You need to be sure that the previous year's history is actually on file before you use that contribution room noted in your My CRA account, because it may not contain your previous year's transactions, especially at the beginning of the year. Third issue for retirees. If you become a non-resident, you cannot contribute to your TFSA. If you do, you face the same 1% monthly penalty. Stay clear of these issues by using TFSAs for long-term passive investing. Do your due diligence and hold quality investments. Don't day trade within the TFSA. As well, keep quality records of contributions and withdrawals. Don't rely solely on the CRA's website. Audit target number 5, crypto assets and digital transactions. As of January 1st, the CRA's new crypto asset reporting framework is now in effect. Many crypto platforms are now required to collect and retain detailed information about transactions, crypto-to-crypto trades, crypto-to-cash exchanges, and certain transfers to unhosted wallets. The first action reporting to the CRA will happen in 2027 for your 2026 transactions. But here's the critical point. The CRA will cross-reference what platforms report against what you're declaring on your tax returns. For Canadians in retirement, this matters even if you're not actively trading. Maybe you bought Bitcoin years ago and forgot about it. Maybe you accepted crypto as a payment for property sale. If there are reportable crypto transactions connected to your identity, the CRA is increasingly able to detect them. What you need to do, ensure all crypto holdings are properly reported on your tax return. Capital gains from crypto are taxable, just like stocks or real estate. If you have unreported crypto transactions from previous years, the voluntary disclosure program might be an option. Keep detailed records. The CRA requires you to track cost base, transaction dates, and the nature of each transaction. The CRA's enforcement priorities this year are clear: real estate transactions, aggressive tax planning, foreign property reporting, TFSA misuses, and crypto assets. They're using AI and sophisticated data analytics to identify non-compliance. For Canadians in or nearing retirement, these priorities matter because your accumulated wealth likely touches on one or more of these assets. Proactive compliance is always better than reactive defense. The CRA receives automatic information from financial institutions, crypto platforms, foreign governments, and property registries. They're using targeted, data-driven approaches to find the highest risk situations. Make sure your tax filings are complete and accurate. Review complex structures with a qualified professional. File all required forms. Use your TFSA for long-term passive investing. Report all real estate transactions and track crypto properly. If you discover past errors, address them through the voluntary disclosure program before the CRA fines you. The cost of non-compliance, penalties, interest, stress, and professional fees far exceeds the cost of getting your tax affairs in order now. Most compliance issues are fixable if you address them early. Work with qualified professionals, keep good records, file on time, and be honest and complete in your reporting. If you're a Canadian retiree or within 10 to 15 years of retirement and you want to avoid these tax traps, now is the time to build, review, or fine-tune your strategy with our holistic Next Step Wealth Management service. Click the link in the description to book a consultation. We work with our clients to plan, implement, and manage well-thought-out compliance strategies that reduce tax, provide sustainable income, and create certainty in your retirement. Let's take the next step.